Hello and welcome. Thank you for joining the Mini Spotlight webinar series. This is the Latvian American Chamber of Commerce Mini Spotlight webinar. You have found yourself on this beautiful March 18th. We are back for 2025. My name is Kristīna Manovska-Twidwell, and I'm the Executive Director for the Latvian American Chamber of Commerce. We exist to foster Latvian and U.S. businesses' interests and facilitate networking and the exchange of knowledge among our members, partners, as well as foster trade and investment between Latvia and the United States. We are the Chamber of Commerce connecting Latvia and the United States. These webinars are created in partnership with the Red Jackets and the Latvian Investment and Development Agency, aimed to showcase the progress, alliances, and opportunities in doing business between the states and Latvia. Today, we are highlighting the startup and venture capital world of the Baltics. We are honored to have Ģirts Graudiņš, LACC Regional Co-Director and founder of the Baltic Way, to lead a discussion with experts in this field. Before we're going to jump in a lively discussion, we will first hear an update on the latest of trade, tariffs, and the first weeks of the new administration policies from Beau Jackson. Beau is a partner of the law firm Husch Blackwell, headquartered in Kansas City, and he specializes in these topics. We're honored to have him here today. And finally, after the wonderful discussion in the webinar, as it has been custom with the last few mini spotlight webinars, we will have a virtual networking opportunity. So we welcome and encourage you to stay afterwards and join us to network with the folks that are going to be part of this discussion, as well as other attendees in the room. So I'm going to bring on Beau and have him join us and give us an update on the wonderful things that are going on. So welcome to Beau.
Hey, Christine, thanks. Well, greetings everybody from sunny but very windy Kansas City, right here in the middle of the United States. It's a pleasure to be here with you all today. So thank you, Christine, and thank you to the Latvian American Chamber of Commerce for this opportunity. Let me apologize in advance if anybody was attending today because they heard Beau Jackson from Kansas City was going to be one of the speakers. Then I sincerely apologize. For the sports fans on who may have gotten excited thinking it was the other Beau Jackson, I'm really sorry about that. Unfortunately, as you can see, I am the lawyer Beau Jackson, not the former prolific football and baseball player Beau Jackson, but coincidentally also in Kansas City like he was. So anyway, sorry about that if anyone's disappointed, but it's great to be with you and to have a few minutes to talk about what's going on in international trade, and in particular, with respect to United States trade policy with the rest of the world. We were joking in preparation for this discussion that I could basically just get on and say the word tariffs and then log off and go about my day, because as most of you probably know, that one word would kind of sum up what's been going on in international trade policy in the United States over the past couple months. But let's break that down a little bit and try to provide you all with a little bit of context in terms of what's driving these tariffs and other trade developments from the Trump administration. And so where I'd like to begin in that regard is talking about the paradigm shift. I think we would all generally agree that from roughly the end of the Cold War up until maybe the end of the Obama administration, so think, early 1990s through 2014, 2015, we were in this period of multilateralism is good, liberalizing international trade is good. Kind of the high point of this was the admission of China to the World Trade Organization, which went into effect right around 1999, 2000. And so tariffs were dropping, at least from the United States' perspective, and what it was having imported into this country, including from China. And that was kind of the high point for globalism, multilateralism, free trade, whatever you might want to call it. Of course, we can say factually, not being political, that did have various ramifications for the industrial sector in a variety of developed economies, including in the United States, where you saw manufacturing leave the United States, move to lower cost countries, most notably China. So there was a building sense of consternation regarding what so-called free trade was doing to developed economies, including in the United States. And then, of course, with the election of Donald Trump the first time, we kind of saw protectionism 1.0. And I don't use the word, the terms free trade or protectionism to convey any of my own personal viewpoints. I'm just trying to summarize how we got to where we currently are. So the Trump administration's first go around, we saw, of course, the imposition of the Section 301 tariffs on pretty much all products imported from China. We also saw the imposition of steel and aluminum tariffs from virtually every country in the world. Although what ended up happening back in 2018, 2019 is certain countries were able to negotiate quotas or other sorts of preferential schemes for their steel and aluminum exports to the US market. But those were kind of the main things we saw during Trump 1.0. The China tariffs, which ranged from 7.5 to 25%, and of course the steel and aluminum tariffs of 25% and 10%, respectively. Then, of course, we had a change, and the Biden administration, interestingly, for the most part, continued the Trump administration's trade policies. I think everyone knows that the Biden administration and the Trump administration disagree on just about every policy issue there is. But a point of emphasis here is that for whatever reason, the trade differences did not manifest themselves in any substantial and pragmatic way. And by that, I mean the Section 301 tariffs on imports from China remained in effect. To a certain extent, steel and aluminum tariffs remained in effect. So the protectionist perspectives, if you will, for the most part, remained in force over the last 4 years. And I say that because I think there is kind of a new bipartisan consensus, rightly or wrongly. And again, I'm not passing my own viewpoints on here. I'm just trying to report the news, as they say. But there's a new bipartisan consensus, which is maybe too strong of a word, that we need in the United States to be a little bit more protectionist. We need to get a more level playing field. Yes, we're a consumer economy. Yes, we want cheap imports, for lack of a better term, to stock the shelves of Target and Walmart and other things. Yes, manufacturers need imported items for their supply chains. However, we can't go back to where things were 10, 15, 20, 30 years ago. Free trade had consequences, and we're not going to go back to that. So I think there's this bipartisan consensus to a certain extent that you're seeing now play out in the policies of Trump 2.0. But of course, it's kind of going even more full throttle. So what has happened over the last couple months? You have seen additional tariffs on imports from China. So the Section 301 tariffs never went away, and now there's additional tariffs on top of that. And of course, those are in addition to the general rate of duty. So if a particular product imported into the US market from China already had a 5% tariff, and then there's the 25% Section 301 tariff, and now there's an additional 10%, you can see how those start to add up pretty quickly. A lot of companies over the last few years, because of the China tariffs, moved their supply chains to countries like Vietnam, Cambodia, and to a certain extent, Mexico. Now, of course, what's happening is you've got proposed tariffs on virtually anything imported from Canada or Mexico, unless it qualifies for duty-free treatment under USMCA, which is kind of NAFTA 2.0 or the United States-Mexico new free trade agreement that's in effect. Canada is taking a somewhat more aggressive approach with the Trump administration, whereas Mexico has tried to be a little bit more conciliatory. Neither of those really seems to have worked out for them just yet. But the point here is it's not enough to get your supply chain out of China. Even when you import from other countries, including Canada and Mexico, those products might be hit with some very heavy tariffs. We've also got new steel and aluminum tariffs. It's no secret that the domestic steel and aluminum manufacturing industries are very close to the Trump administration's heart. And so that will continue to be something to watch. And I know U.S. manufacturers are concerned about that, because what the tariffs do is not only raise the cost of the imported steel and aluminum, but embolden the U.S. manufacturers of steel and aluminum to raise their own prices. So there will probably be an increase in prices of certain industrial goods, even if they're manufactured in the U.S., because of the indirect impact of those tariffs. Now let's talk about the EU, and sorry for kind of belaboring getting to that, because I know this is predominantly an EU-oriented audience. Strangely, the EU has been somewhat out of the Trump administration's crosshairs so far, of course, with the exception of steel and aluminum. But you don't see an effort to slap EU-wide tariffs on virtually any product imported from Europe into the United States. There's probably a lot of different geopolitical reasons for that. But the takeaway, I think, for now, is that there's no issue that the Trump administration wants to address with the EU, that it's going to use tariffs as a negotiating tool. We all know why tariffs came into effect for Canada and Mexico. It's because of the border, illegal immigration, fentanyl, those sorts of issues. And so we're seeing trade policy be used as a cudgel to achieve concessions on non-trade issues, such as immigration. So far, there have not been any similar or concomitant efforts to use tariffs or other trade measures to extract concessions from the European Union on other things. Just think about the Ukraine war, right? That's currently a bit, the Russia-Ukraine situation, a bit of a divergence between the United States and some of its European allies at the moment, but we're not seeing, at least not yet, an attempt by the Trump administration to use tariffs as a way to get the EU to come to the US perspective on that issue. So that could change. It's certainly something to watch for. But I think the takeaway is this is evolving very rapidly every week, if not every day. And companies who are in the crosshairs, who have international supply chains, of course, are having to contend with this. So I think it's incumbent upon companies to lobby. I know that's a bit of a dirty word, but if companies are part of a trade association and they have a position for or against certain tariffs or other trade measures, now is the time to make those voices heard. Probably the best agency to do it before is the Office of the United States Trade Representative, which is essentially the White House's International Trade Office. There's other federal agencies, of course, that are involved in trade policy, but with the Trump administration, both last time and this time, trade policy is very central to how they see overall economic policy, and they don't outsource it to sort of ancillary federal agencies. It's really kept in-house, so to speak, with Peter Navarro and other advisors at the White House and to a certain extent at the U.S. Trade Representative. So if your business is impacted by any of this, or if you have perspectives that you want to be heard, those are the places you need to try to make your perspective known, both to the White House and to USTR. I will stop there. I think I may have gone over by a minute or two, and I'm happy to answer any questions.
Thank you, Beau. That was perfect to address a really complicated topic that, as you mentioned, changes by the hour. We do have a little bit of time to take audience questions. So if you have a question for Beau that you'd like us to answer, feel free to utilize the Q&A feature, or you are able to type something in the chat as well. Just make sure it can be seen by everyone. So I'll give it just a minute or two before we kick off and talk more in depth about startups and venture capital in the Baltics.
Well, we wait and see if there's a question, Christine. One thing I'll comment on very briefly is the export control side of trade policy. I didn't go into that. I talked mostly about import tariffs and whatnot. But for businesses who have who are shipping in products that may be subject to foreign sanctions programs or export controls, I think the Trump administration is going to be a little more hands-off in that regard. Whereas from the import perspective, making sure your products are classified correctly, that you're paying all applicable duties, et cetera, I think the Trump administration is going to be more aggressive. So you're going to see, I think, a divergence in terms of where they are putting their enforcement energy. And I think it's going to mostly be on the import and the tariff side rather than on the export control side.
Thank you, Beau. We do have a couple of questions that have come through. So the first one is, what was the effect of Trump 1.0 tariffs?
At a high level, the effect was to stimulate some supply chains moving out of China. You had a lot of companies, if they could obtain the same gadget, component, article, whatever it is, from a factory in Vietnam or Cambodia or elsewhere, they would try to shift their supply chains out of China. That was probably the main takeaway. The fact remains, however, that China is still, I think, the number 2 or number 3 U.S. trading partner, right in there with Canada and Mexico, in spite of those tariffs.
Couple other questions. Are there any program in the U.S. for Eastern Europe and the Baltics, like to enhance economic development, that you know of?
That's a great question. There probably are. I apologize that I can't name any off the top, but there is a great little agency called the United States Trade and Development Agency, USTDA, and they have for decades worked to try to facilitate commerce between the United States and certain less high profile economies. I don't want to say developing economies, because I'm not trying to suggest Eastern Europe is not an advanced or developing economy. It is, of course. But I am almost positive that USTDA runs some programs, which may include grants and other things, that try to facilitate economic engagement, trade, and investment between U.S. businesses and Eastern European economies.
Great. One other question that I see is there a different HS classification comparing to EU HS codes? I know enough to be dangerous. I'm not quite sure what HS stands for. So Stefans, if you could type in the chat a specific explanation on that, that'd be great. Customer codes. Okay, perfect. So is there a difference in customer code classification comparing to EU to customer classification codes in the States? I would imagine
Really?
so.
Yeah, good question. The short answer is no, because the harmonized system, the HS, is global in nature, and then each country kind of has its own tailored version of that. In the US, we call it the HTS-US, the Harmonized Tariff Schedule of the United States. And so every product imported into the United States, no matter what country it's coming from, has to have an HTS code. And it's the HTS code, in part, that controls the duty rate. However, and this may be what the questioner is asking about, if a product under the same HTS code from China is imported from Latvia, it is almost certainly going to have a lower duty coming from Latvia, because the tariffs applied to HTS codes are country specific. And if there's a free trade agreement, those sorts of things. So there can be different duties that apply to the same HTS code, but the HTS code is the same regardless of what country it's being imported from.
Thank you, Beau. I fear that in the interest of time, I'm going to just ask you one more question. We're going to have to leave some unanswered. So this is a really hot topic. We're certainly going to revisit it. So thank you all for submitting the questions. During the first Trump administration, there was an indication that he would pursue a bilateral approach to trade negotiations. Aside from the tariff war with Canada and Mexico, is there any indication during the second administration that the administration wants to negotiate a bilateral trade agreement, for example, with the UK?
Yeah, you know, FTAs have kind of gone out of style. When I interned at the USTR back in law school 20 years ago, FTAs were all the rage, and that was during the George W. Bush administration, his second term. You know, the TPP, the Trans-Pacific Partnership, which was not just bilateral, it was going to involve a handful of countries in Asia. You know, the United States pulled out of that during Trump 1.0. And there really has never been much more discussion, either during the Biden years or right now, about FTAs kind of becoming a priority from a trade policy standpoint. However, I would predict that whether it's the UK or other countries, that will become vogue again, because we know that the Trump folks' style is to kind of play people off of each other and get a deal with country A that you can kind of use as leverage against country B. So I would not be surprised if we hear talk of some strategic FTAs, pick an ally in South America or an ally in Asia, maybe the UK, who knows? But I would predict that we'll see renewed discussion of potential FTAs here in the next couple of years.
Thank you, Beau. I think this was wonderful, and clearly, as I mentioned before, a hot topic. Feel free to connect with Beau on LinkedIn. He is the international trade expert from Husch Blackwell, based in Kansas City. We're incredibly lucky to have him this afternoon. So again, just reach out to him on LinkedIn, and we'll be sure to share his information. So we're going to move on. Apologies to those that did not have their questions answered. We're going to move on to the rest of the discussion for this afternoon. So next up, I'm going to bring up Ģirts. We are so honored to have Ģirts Graudiņš here. He is, I'm going to read his bio. I apologize for having to read here, but he is a tech investor, and he's been really active in startups that have had successful exits. So he's a Latvian American technology entrepreneur, building businesses and running engineering teams at Silicon Valley startups for over 15 years. Had two successful exits, most recently from Twilio, hopefully I pronounced that correctly, where he built and scaled the video platform. Ģirts is the founder of the Baltic Way, LLC, a consultancy advising ambitious Baltic startups scaling in the US. He's active investor in the Baltic early stage startup ecosystem, and he's as a venture partner in Change Ventures, and then he's also on the investment committee for BADideas.fund. And I know we're going to have a couple of people from these organizations present today. So without further ado, I'm going to bring Ģirts.
Hi, good morning, Christina. Nice to be here. So we're here today to talk about startups, venture capital, and the Baltics. It is hard enough to get a startup off the ground, and it gets even more involved when you have the additional dimension of geography, which is to say, trying to start a startup in the Baltics and scale it in the US. And we have today gathered a group of panelists who actually deal with this on a daily basis. We have people from the Baltic ecosystem, as well as people who are US investors, but have a focus on Europe and Baltic startups. So I'm very happy to kind of get that conversation going. I hope to have a great conversation and have some nice takeaways for everybody. And we'll also have questions and answers at the end of this, and of course an opportunity to network later on. So I see we have the first panelists joining, so let's do some rounds of intros. Let's start with Ben. So Ben is a general partner at BADideas.fund, and a great fund in the Baltics, a new fund coming onto the scene. Welcome, Ben.
Thanks, Ģirts. Excited to be here. And yeah, thanks for facilitating the conversation today. Looking forward to it.
Absolutely. Maybe for starters, you could tell us a little bit, a few words, maybe the origin story of BADideas and what makes BADideas unique and special in the ecosystem.
Yeah, sure. No, I appreciate the opportunity. BADideas.fund started 3 years ago, and it was a very simple idea, which was a group of former founders and operators that wanted to start angel investing together and really be the kinds of investors for startups that we all wish we had when we were initially fundraising. We did a few deals and then started seeing that other people wanted to join. Fast forward 3 years later, and there's approximately 300 members of our angel syndicate who are all founders and operators backing the companies that we invest in. And we have a co-investing fund that invests alongside the syndicate. That's a 22 million euro fund that we just launched this year. We focus pretty early, pre-seed and seed stage companies, mainly Latvia, Lithuania, and Estonia, but a little bit in the rest of Central Eastern Europe as well.
Fantastic. And full disclosure, we know each other pretty well. I'm on the investment committee, so there's that. Excellent. So moving on, let's introduce Janis, Janis Skriveris. You're an investor with the Plug and Play Ventures. Can you maybe tell us a little bit more about Plug and Play? And it's actually a pretty interesting and unique organization and all the things that it does.
Can I tell you? Maybe I will for sure tell everyone what we're doing. That's why I'm here. No, first of all, great pleasure being here. Thanks everyone for putting this together. Thanks, Ģirts and Christine, and all the attendees as well. I see there should be some familiar names in the attendee list too. So hi to those friends and connections. Plug and Play, as Ģirts said, is a pretty unique firm to begin with. It's an early stage investor predominantly. But we also have this second side of business, which has to do with corporate innovation. So on top of investing in the brightest minds all across the globe that are building their pre-seed and seed stage businesses at this point, we also make sure that we help them with commercialization. We help them with hitting their next milestone for the subsequent funding round, and just in general to find new customers, because Plug and Play also works with a vast plethora of Fortune 500 companies. Those could be the likes of Walmart, Nike. We work with automakers, which we will probably touch upon as well when it comes to the tariffs and what that does for them. But essentially, we are a super connector between everything that the startups need and corporations that could be the biggest allies at these early stages for the startup company.
Fantastic. Thanks for that. And next, we have Serhat Pala. Serhat is a really big figure in the San Diego startup scene. He's a general partner at CrossOcean Ventures, as well as president of the New Fund. So those are kind of the two of the many hats that Serhat wears. So thanks for joining us, and perhaps you can tell us a little bit more about CrossOcean Ventures and the concept of the venture group, which is something that you're also innovating on.
Thank you. It's great to be here. I mean, yes, today I'm wearing two different hats. One of them is CrossOcean Ventures, which is a fund focused around immigrant founders, particularly from European origin, in the B2B SaaS space, coming to the United States with the goal of making United States their primary ecosystem that they would like to go ahead and not only grow sales, but ideally find Series A lead investors and grow. And on the New Fund venture group, that is somewhat of a different concept. I mean, traditionally we're used to either early stage venture funds that are venture capital firms that operate with funds, have GPs, and make investment decisions with the GPs leading the charge and the LPs, limited partners, investing the funding, and then angel groups where investors making individual investment decisions. New Fund Venture Group started as Tech Coast Angels in the 90s, more than 25 years ago. But about 7-8 years ago, realized some of the challenges that the angel investor networks have in terms of being not fast enough, professional enough, or deploy funds, in significant amounts. And then at the same time, still has both the angel investors and the investors that would like to be a part of the founder's journey beyond with just the ROI in mind, and bringing those two models together. Whereas we have a group of 350 very active members that not only write checks themselves individually, but then they also operate under the New Fund Venture Group's venture funds and become both LPs and GPs at the same time. And we all get to make investment decisions that are fast enough, yet decentralized enough that only in each area the experts can participate. So so good to be here.
Fantastic. Glad to have you here. And we already learned something new about the concept of a venture group, and definitely resonates with somebody like me who's dealt with syndicates and kind of is aware of the various challenges that syndicates can have potentially. So since we're here dealing with Baltics in the US and startups, kind of navigating that space of starting in the Baltics and going for the US market, maybe we can quickly, each of us, kind of reiterate the specific way how your fund views startups and what they go for. So maybe let's starting with Ben. In case of Bad Ideas, what is the kind of like your angle and how you look at startups who are trying to go for a US market?
Yeah, no, it's a good point. So the first thing I would say is one of the things that in case you can see my last name, I'm not from the Baltics originally. I'm actually originally from France. So what drew me to the Baltics, in fact, was the capability of European founders to scale directly to the US. So a couple things from a regional standpoint, and then I'll kind of dive into what we specifically look for is the markets are pretty small, right? As we know. So founders are already thinking about global problems immediately, global business problems in our case. And that's the first thing that attracts an investor like me to the Baltics versus, for example, France, where you might, the market is big enough for you to be thinking about French problems and not global problems. And the second component is language. Right? English is so prominently spoken that the ability to scale and build relationships, business relationships, transatlantic is much, as simple as that may sound, is much easier, for example, than if you're a Spanish-speaking or French-speaking founder for whom English may not even be a comfortable business language. But the third, and this really kind of is where our thesis is really about founder quality. And that quality is technical capability, to build great products and services for businesses, but work ethic and grit. And so for us at Bad Ideas, we're looking typically at companies that are very early. They might have or might still be building the first version of their product. And what we're attracted to is founders who have already talked to prospective US customers. And that could be in the form of doing customer discovery to learn about their pain points. It could be in that they've launched their product immediately to the US market to see, like, can we sell this in the US? But something that shows that the founder has a very high, placing a high importance on velocity of going to the US. And that can be really, as I said, super early. And these founders don't necessarily need, or usually not in the US, they're usually in the Baltics. But that's typically what we look for is really, really talented, ambitious founders who super early are doing stuff, whether experiments or selling products and services already touching US customers, business customers. And I'm based in the US, so if I can learn something from a Baltic founder who's 4 months into their new company about what a customer wants or needs in the US, and I didn't know that, it's typically already a pretty good sign that they're very intent on launching into the market.
Fantastic. Janis, how about plug and play? What's the attitude at your organization?
I don't want to repeat what Ben said to the T, but it's certainly the team aspect that we're looking for. Gritty founders. I love when founders have their own kind of personal reasons and professional past that makes them want to solve the solutions that they're addressing right now, because then they very intricately and closely understand the pain problems of the industry, of the main user. They know how to approach the customer. They know how to exactly explain the product and its features to whomever they're selling to, versus just trying to jump on another hype train. Like we all saw what happened with all the blockchain and Web3 craze a few years ago, or when ChatGPT became more adopted and launched to some of their newer models, then everyone overnight became an AI expert and started building products for God knows which user group, So having a little bit of that personal connection and understanding of who they're selling to and also why. The other thing I would say, global perspective is one, and obviously a lot of these founders will often look at US as a very prospective market because Silicon Valley success stories and whatnot, but it is also a very crowded market. So not only do you need to be greedy and understand who you're selling to, there needs to be a clear value proposition, especially at these early stages. Have some differentiating factor, have a moat to your product, have a unique perspective, unique set of data that you can train your models on. And that way you can differentiate yourself from any of the local incumbents. And that's obviously going to be a much bigger drive for the investors to look at you, as well as make customer acquisition so much more easy. So yeah, I'll stop at these. I think strong team and a good perspective of why you're building this and why exactly this is the best thing ever after sliced bread.
Excellent. Serhat, what about you? What about Cross Ocean Ventures?
I mean,
Same deal? Or
yeah,
slightly
all
different?
all the good stuff Janis and Ben talked about. So what I can maybe emphasize is something that is maybe more specific to Baltic. So I think, you know, the size of the market is primary. And Ben made a great point about the France being just big enough so that, you know, founders might be able to talk about and think about French problems, or having a difficult time when to make the ultimate switch. Like, you know, the way at Cross Ocean we like to, you know, work with founders is we like to work
that can you hear me? I just
Yeah, it switched.
Yeah.
Yeah.
You know, the founders need to make sure that the you know, the US is the primary goal. With regards to Baltics, I think the size of the market is small enough that it's a great place to start. Try to, you know, pivot, think about scale, think about building first. But while you're doing it, you're ultimately building for the global market, and that speed, and plus I think that especially in the Baltics, there's already a tradition of examples of successful founders. I think that that creates a lot of inspiration from, you know, up and coming founders that sees how things are made and how the switch from Baltics to the US is made. So I think it gives the Baltic founders a little bit more edge than some other you know, European founders that might be operating and starting in, you know, larger size countries that can try to stay local, both with their investor ecosystem, but also their sales.
Cool. So one thing now that we've kind of introduced everybody, set the stage, one thing I kind of quickly wanted to get covered is the topic at the top of the hour was the impact of the new administration on businesses in general. Quick pulse check across the panel here. Are you seeing any changes, difference in your startups, in your portfolio, or fundraising, or, you know, team building, or anything at all that is a change from before with the new administration? Just a quick pulse check. Yes, no, any anecdotes that you may have from portfolio companies?
A couple of things that pop up maybe you know, quickly. One is supply chain is more of an issue than ever before. So, you know, in the past we didn't have to drill down and understand the, you know, the supply chain and what a you know, scalable organization and its supply chain looks like. You know, what countries, what's the flow of the material and elements. Now it becomes a bigger issue. The second one is not necessarily tariff related, but in the short term, the changes in the research and grant model in the US, how the research grants are given, and especially in certain industries like deep tech and medical devices, how the US research system works. Right now, we're going through some transformation of change, and we have already, even in this short time, have started seeing some of our portfolio companies or prospective, you know, companies that have to make up for some of the, you know, like the research that they'll be using. And I think unless there would be more clarity and people will understand how that, you know, our research grant structure changes, I'm afraid that we might have a lot of early stage companies that depends on those grants will gradually find new ways, and there might be some mission critical challenges that early stage companies at that early revenue level might have to deal with that I can see in the front lines.
Yeah, I think grants is a huge topic, and as Serhat also said, it's supply chains. If you thought that supply chains were terrible during the COVID-19 pandemic, then now companies are seeing it at a whole different level because it directly impacts the cost structure and everything that they're dealing with. I can't speak about all the industries, but I heavily focus on everything that has to do with automotive, with deep tech, with manufacturing tech. So obviously these tariffs now are messing up the supply chains, and that obviously opens up a huge opportunity for supply chain optimization and onshoring, and a lot of that is something that our portfolio companies are talking about. On the flip side, I would say, while it is more a more friendly environment for these manufacturing companies and maybe the energy sector, clean tech might be facing a little bit more of headwind situation. Everything that had to do with ESG, maybe some carbon tech. It's not necessarily the climate, no pun intended, in United States that's too friendly and favorable for them anymore. So what we're seeing is that they're also looking for more customers and more opportunities outside of the United States, where some of these policies are still very much in effect and provide a good market opportunity and path to scale.
Yeah, that's a really good point. One angle that I say we're thinking about it. It's happening all in real time, right? So maybe I woke up this morning and had this thought. But something that I'm thinking about a lot in the impact of economic policy and general policy in the U.S. as it relates to our thesis is there is, at least right now, a much greater momentum. Some talk, some action in Europe to be building its own financial, technological, and industrial autonomy from the United States. And that's, we have to see how that plays out. But one of the things that I'm interested in, a couple of ideas of how this is going to play out for us over time when we think about the companies we invest in is, will there be greater capital in Europe to invest in early stage innovation across different industries to create that autonomy, both in public and private sources of funding? Will that impact whether or not investors will say to early stage companies that they should be focusing more on Europe in terms of where they sell their products and services versus the United States? So those are things that I'm thinking about, and we don't know, right? Like, as I like to say, like it's like day 53 of the Trump administration. So there's a lot of change that is happening in real time. There's a lot of talk that hasn't materialized, and vice versa on the other side. But as much as there's change in the United States, and we think about how does that impact the U.S. market, I am very intrigued to see how does it impact how Europe mobilizes around early stage technology, where we've seen way less funding, way less risk-taking appetite, way more uncompetitive pricing early for companies that makes it hard to continue to scale and continue to raise a lot of money into later rounds. So I think that's going to be interesting to see how that evolves over the next year or two, and if that maybe creates some nice tailwinds for early stage European companies and the funding environment.
Yeah, so that could certainly be an opening or kind of a new avenue for European startups. Kind of continuing on the theme of current events, defense tech is another area that's getting a lot of attention recently. There's a rise in demand, for one thing. I should pause and plug our LACC event in October. The sort of our big keynote event of the year is also around defense, so sign up. But coming back to VC and investments, typically a lot of LP agreements, kind of exclude defense investments and so forth. How do you, well, I guess, first of all, what is your own firm's kind of stance right now, and how do you see that evolving? And maybe let's start with Serhat and do a quick round from there.
Yeah, I mean, like it's a complete tide shift. I mean, defense tech 3-4 years ago was not an easy place to be, but now, it is definitely the hottest and the most active area. And I've seen some funds that looked at the word defense as a word that they do not like to, at least in openness, be warned to use different forms of tech words to incorporate defense tech without necessarily saying defense tech. So I think a lot more funds are open to that subject. And plus, I mean, when you look at some of the hot areas of defense, from like mobility to cybersecurity to robotics and energy, like in true sense, defense tech is pretty much everything that has to do with all these different aspects of technology. Was there a specific question, Ģirts, that
your own fund's stance, right? So if I'm a Baltic startup, should I go to Cross Ocean Ventures with a defense pitch deck?
Yeah. So for new fund, like we do with Cross Ocean, we are a lot more on the software, even though we are not like in our thesis, we don't say, oh, if it's hardware, we have to pass. But just by the nature of the amount of funding and the potential dilution aspect of things, we'd like to keep the hardware side and the capital requirements to a lesser degree. But in general, I think this whole major fundraising that happened in the 2020, 2021, and the amount of funding and then amount of great companies right now waiting their line to be able to do their Series A created a completely different type of, I think, pipeline of deals that the VC firms have to deal with. And now, this already complicated decision making became even more complicated by funds like us, also considering what kind of companies can actually raise funding. Not necessarily can they make it, can they, is that a great value proposition? Can they scale? Or is this a great founder team? But the question of companies being able to continue to fundraise in this funding structure became one of the most critical decision-making points for early stage funds and early stage funds that deal with especially immigrant founders.
Oh, well, Ben, I know we've had lots of debates internally. Do you want to kind of share the latest on the defense tech from Bad Ideas?
Yeah. So the first thing, and I'll try and be short on this, is we are predominantly B2B SaaS, right? So that doesn't mean, to what Serhat said, like if an exceptional deal comes and we have high conviction and it's not exactly in our thesis, we can do the deal. But the fact that we're predominantly B2B SaaS already limits sort of like where are we most likely to invest in defense tech. I think the most interesting thing and trend for us to watch in terms of companies, but also like how the market evolves, is that really what we're talking about is increased budgets, right? That people will go after. There's going to be more public funds spent as the percentage of GDP rises, commits to military spending and defense spending. So the interesting thing for me to watch is a defense tech sector in SaaS likely to come up and stand on its own two legs in Europe, or is it more likely that we will see many more companies that are selling into defense and military that are also selling into other industries? So depending on where you are, like you could find a lot of commonalities, for example, between high complex extractive industries like oil and gas and mining, and defense, right? Whether that's the security requirements and whatnot. So I think that's one trend that I'm interested to see is like, will that increase in pool of money and the culture around building companies lead to a more US style where like you just build startups for defense many times? Or are we likely to see many more SaaS companies, and again, SaaS being our space, that are kind of selling into military as well as other companies, other industries? So that's kind of what I'm watching at the moment.
What about you, Janis?
Yeah, I mean, I think dual use startups will be king. It's as long as you can not only diversify your risk by working with the commercial sector, but also have that additional revenue that's maybe easier to sell and easier to lock in for the R&D, for the development, especially the early stages. It's only going to do favors for the startup. If you're straight up building missiles, then you probably shouldn't talk to Plug and Play, because there's also not going to be many ways how we can support the startup companies. We work with these large enterprises, as I was talking. So if you have a supply chain use case, if you have AI use case, cybersecurity use case, advanced computing use case, but you also can work with some of the military departments, then it's only going to be better. And we're also seeing the appetite from companies like SOCOM. We work with SOCOM at Plug and Play. We work with some other departments of the military. They are also looking not exclusively at quote unquote defense and like military grade startups, but they are embracing some of these new technologies. And as long as the specs and everything can fit their criteria, they're very much looking at telematics and some of these cybersecurity companies, AI use cases and things like that. So dual use is what I will say. Don't build with just one customer in mind. Same goes with the market topic that we were talking about earlier in the conversation. Don't build just for France, don't build just for Baltics. Have several opportunities open and diversify, and it's only going to make your life easier.
Perfect. So we're coming up to the hour here. I think one of my questions would be, what do you think is kind of the most exciting trend that you see of late in the industry, specifically as it comes to Baltic startups going to the US? What's a thing that you think is worth sharing other than AI? I'm sure we can all say AI, and that's cool. Is there anything else that you would think of that you're seeing, emerging trends, hot things happening?
We're seeing a lot of cool stuff around.
Yeah, go ahead.
Oh, sorry. Yeah, I can just kick it off. I mean, my mother is talking about AI, and if my mom is talking about AI, then you totally know that it's reached the masses. She's not a technical person whatsoever. But everything else that's happening adjacent to AI. We just recently were hosting an innovation day around data centers, and there's more and more interesting and hot takes for that, because the growth of AI is asking obviously for much more computing power supply, and we're seeing companies that are putting data centers underwater because of the cooling aspect of it. We invested in a startup company that is bringing data centers to space exactly for that same reason of cooling and lower latency in some instances. So a lot of hard tech things that are more adjacent to AI, I would say, is something very exciting that we're seeing right now. I mean, I think deep tech for the better half of past decade and way before wasn't sexy at all, and now finally it's a time when we're looking at hard tech and deep tech and getting our rubbing our hands together, because there's so much more opportunity there than just the good old SaaS platforms and the good old productivity tools. So I'm very excited about that. Everything that can help with the AI deployment and AI development.
All right. Excellent take.
When there's such transformation, and I think as the entire layers of ecosystems are transforming in such a rapid way, I think this is a very exciting time to be a founder. I mean, I sometimes have these flashbacks and itchings about going back and trying to be a founder, because right now, probably since the internet, this is the first time this new early stage founders can use the most important advantage they have, which is their agility and their speed of making changes, can make a big difference in building great companies. And as you need, with more agentic things becoming possible, large language models and the cost of processing decreasing. As a founder, this is an exciting time to be resourceful and creative, and potentially find ways that you can build companies without necessarily right now going and raising, tens of millions of dollars. Yes, there's definitely that too, but I think more and more I see companies that can do a lot with just a few $100,000 to a couple $1 million, and potentially create significant value for themselves and their investors. So that's probably what I'm seeing as the most exciting thing in the short term.
And
Yeah, I'll round it up. I'll totally agree with Serhat on the last point. And it actually makes me wonder every day, like, what will be the role of venture capital in 15 years? I think it will be completely different than it has been in the last 10. So I think that will be very fascinating based on how quickly and how cost efficiently companies are able to scale. More specifically for the Baltics, one thing, just to kind of add a little bit of diversity of idea on this one, is what we're starting to see in each country. For those of you familiar with the Skype effect of being able to trace back all of these Baltic unicorns to Skype, we're starting to see in each market in the Baltics different blueprints play out of specific types of businesses and verticals that the Baltics are disproportionately good at globally. So similar, if you think about Israel with cybersecurity and really became a cybersecurity powerhouse for startups, we look at the Baltics and there's a few different verticals that we're starting to now be able to say with conviction, if a founder is coming from this region with experience in this vertical, not only are they competitive in Europe or here, but they may be one of the best in the world. And that's a pretty cool thing to be able to see. We're seeing that, for example, with drop shipping and fulfillment in the e-commerce space in Latvia, like Printful and Printify have given birth to a couple of other early operators who then form their own companies in those spaces. So for the Baltics, I think that's an exciting time, is starting to be able to say with greater conviction on these verticals, the talent is not just great talent in the Baltics or in Europe, but potentially globally leading talent because of that experience. So a cool trend that we're also keeping an eye on.
I think that's a great note to round out the discussion and go to questions. I think I see some
insightful discussion. So I know we're just at time. So for those attendees that have to hop off, I totally understand. I do want to get to a few questions that have come through your discussion. So, and some of them are very, very good ones. So I'm going to start with the first question. They'd like to see how many each of mentioned funds work with B2B and B2B SaaS segments. Been mentioned the B2B at the moment, but what options, challenges, and advantages do you see B2C market from the investor point of view, Latvia and the Baltics versus US?
If I can, I don't invest in B2C for companies scaling into the US market, not because I don't think it's possible, but B2C is very high culture. It's a super tactile sport, like understanding and feeling a unique culture of a market. With consumers is a very different set of like data inputs in your brain than understanding global business culture and business needs. I can launch a company that's solving a business problem in the US from anywhere. If I talk to 150 of my buyer personas from my ideal customer in the business world, I can get 150 data points that tells me, is this a real problem? Is it worth solving or not? Latching on to cultural phenomena and consumer phenomena is a lot harder in my opinion. So not that it's not doable, but I think that's to answer your question, that is what I think is very challenging of doing something cross-border, particularly when you're scaling into a market like the US that has immense competition for consumer attention.
Anything to add, Janis, Serhat?
Yeah, I mean, and it's plus, besides the culture point, it's, to me, even the toughest part right now in this, fundraising the market is B2C requires more funding because you will have to be spending more to grow faster. And I think non-immigrant founders by nature, being in the US, coming from the US networks and being more closer to the US customer mindset, I think have advantages over immigrant founders when it comes to anything that has to do with B2C.
Same thing, not a B2C investor, tough space. We work with large corporations, so we want to be helpful to the startups that we work with as well. But it is, you have to be within your audience, you have to be able to reach your audience. So distribution is important with all the tariffs. And if we're thinking about CPG and like packaged goods and stuff, then supply chains and tariffs are going to be an issue. So it's a whole different beast, whole different animal. It's just not our forte.
Yeah, but having said that, having said that, there is definitely opportunity there. I think the channel partnership based model of the United States, it makes it available. It makes it possible for immigrant founders to be a little bit more creative at the earlier stages to show, I think, traction and revenue. But it's also something that I see many of the immigrant founders might not be as aware unless they spend time here in the US, how the channel-based distribution structure in the US is completely different than the European. So if I was a B2C software company, I would work with more my GTM and maybe working with qualified, experienced operators that can help me in the US to figure out that might make the fundraising aspect a little bit easier.
So I guess one thing I wanted to highlight. So I think it's the nature of this panel. We just happen to be not specialists in B2C. It's not to say like if somebody's in the audience doing a B2C startup, this doesn't mean don't do it. It just means we are not the right investors for you. There's other folks out there who specialize in that particular vertical, and they will give you a much better and more precise answers, and then you'll have a more interesting conversation with them.
Thank you, Ģirts. I think that's a really helpful comment. I think we'll have one more question, and then we'll be respectful of our folks' time. So we had a question earlier that was submitted that states we are a U.S. market access accelerator specializing in med tech with 40% success rate, companies entering, fundraising, and scaling up in the U.S. We work with a lot of European companies, including a lot of French and even Polish companies, but we have yet to see any companies from the Baltics. Is it because culturally companies feel that they don't need any help? So I don't know who would like to take on this question.
As the Latvian here on the panel, I will say that I think there are some cultural things when it comes to just not maybe feeling comfortable to ask for help or putting yourself out there and trying to do some of these things. I think there is something ingrained in the Latvian DNA for that. But I've also had, just in general, more open discussions with fellow Europeans and startup founders that are successful, that there is a risk aversion when it comes to comparing European folks and what is happening in the United States. And I think that is still a gap that needs to be bridged. We previously touched on the additional kind of opportunities that European investors might be seeing. But I think it's not going to be as immediate because there still will be some of that kind of caution and slowness when it comes to building these ventures, having a global perspective, and really tackling these massive problems. So I think, yeah, it's also sometimes maybe a lack of information and resources, just not knowing what is out there. And instead of seeking for that, sometimes these opportunities come to people, and you just need to act on that. So networking and opportunities like this, I think, is something that will help bringing in these additional perspectives to eliminate some of that risk aversion. It will help spreading the word about some of these new networking opportunities, new accelerators, new locations, new institutions, new whatever. So I think it's just a matter of being open and close with each other.
Yeah, I agree with Janis, and I'll say a little anecdote that So I think Janis and I said at the top, talking about the grit of Baltic founders, right? And grit and risk aversion can sometimes be two sides of the same coin, which is the grit is like, look what I can do, give me one lemon and look how much juice I can squeeze out of it, is also the other side of the same coin. That's like, that's a $400,000 investment, or that's a $100,000 investment. Geez, I need to think about that money going out. Is that really a good use of money? Is that a smart way to spend money? I think I could probably do that for a lot cheaper. I could do that more cost effectively. So I think they're two sides of the same coin. The other element, though, I do want to highlight is like, there's also a funding reality, right? Which is like, if you're a US company, or even if you're a French company or a UK company, when you're, the likelihood of you being able to raise 10 to 15 million in a Series A round is pretty good if you get the results. Historically, in the last 10 years, and like this is for sure true in Latvia, but also to a certain extent in Lithuania, maybe less so in Estonia, is like, there's no guarantee that you're going to be able to raise that amount of money. And so the cost of making mistakes on the runway that you do have, the cash in bank that you do have, kind of goes up. Versus if you're in Silicon Valley, you spend 500K and it doesn't go well, like, yes, you have to go out and figure out how to get your next round. But the global funding environment is much more robust. There's more options, there's more capital. And so for a Latvian founder, for example, at pre-seed and seed, burning 250K the wrong way is a much higher perceived opportunity cost. So on those like consultants, advisors, go-to-market strategists, all these people that cost external money, that's also sort of a reality. And hopefully more money coming into these ecosystems also kind of can reduce that perception a little bit.
Thank you, Ben. Final question, and then we'll go to close out. So you talk a lot about attracting investment. What are the full cycle returns of previous investments, if you can speak to that?
Who wants to take this one?
I'll take it because it's a short answer. We started investing 3 years ago. We've had one exit, which is a very early exit from one of our first investments. But the reality is, from a cash returns perspective, we don't know yet. What we are looking at is what is the trend of the Baltics in terms of producing, as a nice benchmark, billion-dollar companies per capita. Do we think that the Baltics are getting better at that? The answer to that, we think, is a resounding yes, we do. So then it's a question for me, not about whether the Baltics will continue to disproportionately produce more billion-dollar tech companies, being the unicorn factory of the world on a per capita basis. We think that it will be. It's a question of, will we pick the right companies? So market, I think the returns are there. Individual fund, that's where you make your bet, and hopefully you're picking the right founders and backing the right companies.
Yeah, for us, I mean, we have success stories. We have more than 30 companies in our portfolio that have reached the unicorn status. Not all of them have exited. The return aspect, we don't have to distribute any capital because historically we've been investing as a family office, as an evergreen fund. So there's no really LPs to give the returns back to. We just recently started raising and operating industry-specific funds, and neither of those have closed. So there's also no returns really to comment on that front. But it differs. I mean, we were the first money in a company called Honey. Probably you folks know, it's the little digital coupon extension on Google Chrome that you can use to get some automatic discounts. We met the founders early on, just a little coffee shop chat, gave them a small check, and then ultimately the company was acquired for 4.4 billion by PayPal. So it was probably one of our best returns, given the fact that we got in so early and there was very little dilution that happened after the fact. So we have cases like that. We have some companies that have brought back even more returns. But yeah, when it comes to speaking about actual returns, when it comes to like operational funds, we, similarly to what Ben was saying, we just haven't reached that point just yet to report back on them.
With New Fund Venture Group, we have been, even though the 2020, 2019 and vintages after that have been somewhat challenging, and you see a lot of funds not able to return any actual capital back. With our last 6-7 funds, with the New Fund Venture Group, we had successful exits. We're in the top, I think, depending on the vintage, somewhere in the top 10 to 25% percentile in terms of the return. With Cross Ocean, it's a newer fund, and with most of the high multiplier exits, when you talk about for a fund, in fact, having fast return is not a good thing. Usually the J curve happens in a way that your best exits will come in the year 10, 11, 12, which is not ideal, but that's the case. And with Cross Ocean, we have had successful cases, and we do see that 8 to 10 to 11 year life cycle of successful investments. It looks like might even get longer before they start getting shorter again. So I don't know with regards to Cross Ocean when we will hit to that very high multiplier DCPI ratios. Time will tell.
Okay, well, I want to once again thank all of our panelists and Ģirts for moderating. I'm going to move the rest of you folks in the backstage. I appreciate your time. I know we ran a little bit over, and I want to acknowledge that we did have one other panelist planned for today's discussion. Marija Rucevska with Outlast Fund was not able to join us, but we definitely wanted to acknowledge that she was part of the plan for today. So definitely, as we share contact information, feel free to reach out to her as well. So really, this is, LACC aims to provide opportunities to learn, connect, and grow. And our Spotlight Latvia Business Conference that Ģirts mentioned is set for October 15th through the 16th in Washington, D.C. And the focus will be security, all encompassing. So registration is now live on our website, and we do have an early bird discount available for those interested to attend this incredible event. So right now I'm going to launch a poll. Hopefully you are able to answer some of those questions. This really helps us ensure that we are providing the type of content that you want to hear. So take a moment and share your feedback. It's just four short questions about today's event. We want to make sure and continue to provide that content that you're interested in. So if today's program inspired you to pursue United States as your next business opportunity, or you want to learn more about Latvian business climate, please connect with us. We are honored to be a part of the network here, in that we're able to further business connections across the globe. We'd love to hear and learn more about you and your business and how we can help. Thank you again to the Latvian Investment and Development Agency and the Red Jackets, the Latvian Exporters Association, for our partnership on these webinars. This concludes our official program for today. As promised, we're about to launch into virtual networking opportunities, so feel free to stay and make connections with one another. Thank you for staying 15 past the hour. And once the prompt will come up for the breakout appear, you just need to accept it and then go ahead and get to know one another. Our next Mini Spotlight webinar will be at the end of April, on April 29th, and more information on that is coming very, very soon. So thank you again for joining us, and we wish you a wonderful rest of your day.